Okay, so these are some of the end of the chapter exercises in your textbook. This is for chapter 3. And I'm going to walk you through a couple illustrations. This is going to be exercise 3.1, and then I'm also going to show you a little bit of how to do 3.2. So starting with 3.1, the objective is, it says to set up a T account for each account and then enter the balance on the proper side. So I'm going to erase this again. So over here off to the side, I'll do these one at a time. So here's my T account. I'm going to write cash, and as you remember, the debit side is always on the left and the credit side is always on the right side. And so for cash, because it is an asset, and the rule is assets always increase on the debit side, and that's where the plus is, that's always the increase side. So I'm going to put $19,000 on the debit side because assets always increase with debits. Cash is an asset, so you always put the balance on the increase side. So again, cash would have a debit balance of $19,000. So then I would do the same thing for the equipment. So I'm going to write my T account, and again, remember there's an abbreviation for debit. It's actually DR, so that's easier to write. And then for credit, it's CR. Equipment is also an asset which increases on the debit side, so I'm going to go ahead and put the balance on the debit side for that one. Then I'm going to put accounts payable over here. I'm going to write that out. Here's my T account, and again, debit, credit. And because accounts payable is a liability, the rule for liabilities is liabilities always increase on the credit side. So I'm going to put the balance of $24,200 on the credit side. And then finally for capital, capital is the part of equity. And if you recall, equity always, again, increases on the credit side. So that $40,800 goes on the credit side. So again, this is just to kind of get you started with T accounts. Remember, it's universal. Debit is left, credit is right. That's the same for every account. But when you start to use some of these debit and credit rules of where should the balance be, just remember that the balance of any account is always on the increase side. And if you follow the rules of debits and credits with assets and liabilities and equity, just go where the increase side is. That's where the balance should always be. Now, exercise 3.2 is we're going to set up some T accounts to see if we can figure out how to do some analysis in terms of debits and credits. So we've got 5 of them. So on the first one, we've got Denise invested $90,000 cash in the business. So obviously I'm going to again write out cash because cash is one of the accounts that's going to be affected. And when you see this invested word, that's an investment. We're always going to use the word capital. The account capital in this textbook is the account we're going to be using for that. So again, we got our debits and credits, and the basic rule is, in this case, it says they invested $90,000 cash. Cash is increasing because you're putting money into the business. So that's an increase to cash. And so an increase with cash is always on the debit side. So I'm going to put $90,000 debit. And then, of course, with rules of debits and credits, debits, for every debit, you have to have a credit to offset it. So therefore, capital is going to get the credit. So anytime you debit one account, you have to credit another account because, again, I'm going to write this up here to remind you, debits always have to equal the credits. So that's the first one. On the second one, it said you paid cash for equipment, $30,000. So again, you got cash. So I'm going to set up my T account. Here's my debit credit. And it looks again like they bought some equipment. So I'm going to write the equipment. All right, so again, debit, credit. And remember, these are both assets here. So one asset's going to increase and the other asset's going to decrease. So I know cash is going to be decreasing because you're paying it out. It's going to leave the company. So to decrease an asset, you're going to credit it. So that's $30,000. And of course, we're going to have to debit something else, but we're buying equipment, we're increasing equipment, so therefore we're going to be debiting equipment for $30,000. On the third one, it says perform services for cash, $9,000. So again, I'm going to write out cash again. Here's my T account. We've got a debit and credit. And performing services, I'm just going to use revenue. Your book likes to use fees income, but just to kind of keep it simple on this illustration, I'll just use revenue. And of course, it says we perform services for cash. You're going to be increasing or debiting cash for $9,000. So then you have to have a credit to offset that. You're increasing revenue, which is an increase account on the credit side, that's also going to be 9,000 credit. Notice debits equal the credits. Number 4, paid cash for advertising expense. So I'm going to write out advertising expense. There's my T account, and then I'm going to write out cash. There's that T account. So again, we've got your debit and credit. Notice that's always universal. Debit's always left, credit is always right. So we paid cash, we're going to be reducing cash or crediting cash for $3,800, and we're going to be debiting advertising expense because we're increasing our expense. Notice debits equal the credits. Last one said you paid $3,000 cash for supplies. Again, I'm going to write out supplies T account and the cash T account, and we've got a debit and a credit. And then just think about it. We're paying cash. We're going to be reducing cash. So we're going to credit cash for $3,000. And then supplies is an asset. We're increasing it. We're going to be debiting that for $3,000. So again, notice our debits equal our credit. So there's some, this to kind of get you started with some basic debit and credit analysis using T accounts. All right, so on this one is exercise 3.3. And just we're going to go over the rules of our debit and credit balance. Notice a normal balance, think it's always going to be the increase side. So starting with capital. Capital, notice that's going to be a credit balance because equity always increases with credit. Cash is an asset. Assets always increase with debit, so that's going to be a debit balance. Fees income is revenue. And revenue is on the equity side. Revenue always increases with credits, so that's going to have a credit balance. Accounts payable is a liability. Liabilities always increase with credits, so there's where the balance should be. So that's a credit balance. Supplies is an asset, just like cash, so the balance should be on the debit side. Supplies expense, that's that weird category where supplies expense actually reduces equity, but every time you record it as an increase. It's almost like increasing a negative, but that one is a weird one, but that one works just like the assets. That one has a debit balance as well. Accounts receivable is an asset, increases with debits. And equipment is also an asset that also increases with debits. So where you see here 1 through 8 says, again, indicate whether each of the following accounts normally have a debit or a credit balance. Just go back and look at the debit and credit rules. Wherever you see that account increases, wherever the increased side is, that's where the normal balance should be. Okay, so on exercise 3.5, we're going to show you how you would actually get the balance for an account. So starting with cash, here's how you do it. To get the balance for any account, what you do is you add up the debit side, you add up the credit side, and you simply take the difference. The balance is always on the side that's the greater. So for cash, if you were to add just the debits, 190 plus 30 plus 3, you're going to get a total debit of $223,000. That's your total debits. For the credits, if you then add up all the credits, 46,000 plus 700 plus 11,000 plus 5,000, you're going to get $62,700. So you add the debits, you add the credits, and then you have to take the difference. The balance is always going to be on the side that's larger, which in this case is the debits. So if you take the 223, subtract the 62,007, you would get a balance of 160,300, which would be the balance for cash. That would be what's called a debit balance for cash. That's all you have to do. If you go to accounts receivable, you have a debit balance of 10,000, a credit balance of 3,000. That's all you have. You take the difference, and in this case, obviously the balance, 10,000 and 3,000, the balance would be a $7,000 balance. That's again on the debit side. You take 10,000 minus 3, 7,000 would be the balance for accounts receivable. Supplies, it says 46,000. There's nothing else there. That's just one account. That's the balance. For fees income, which by the way is your revenue, you add these together, and since there's no debits, your balance would simply be just 40,000. That's it. Wilson drawing is 5,000. Equipment's 80. Accounts payable is 80. Capital's 190. telephone expense is $700, and then salaries expense would simply just be $11,000. So cash is the one you're going to probably have the most transactions with. So if you can follow this, you add all the debits, add all the credits, take the difference. The balance is always on the side that is the larger. That works for every single account. Okay, so last one I'm going to walk you through is parts of 3.2a. Now, notice on this particular problem, they already give you all the accounts to use. So you're never going to try to memorize accounts. So here's the account titles, and then we're going to go through these 8 transactions and see if we can figure out the correct debit and credit analysis. So I'm just going to set up one account here for cash. I'm going to set this up out to the side because we're going to have most of the transactions are going to involve cash. Okay, so starting with number 1. Gloria Williams invested $70,000 cash in the business. Cash is an asset. Cash is increasing. You always increase cash on the debit side, so you're going to debit cash for $70,000. I'm going to write the capital account up over here. Again, debit, credit, and of course, the capital, I'm just leaving the name off. It's Gloria Williams Capital, but I'm actually using this out right there. You would be crediting capital for $70,000. That would take care of number 1. Number 2, purchased office furniture for $17,000 in cash. And so obviously office furniture, they have an account here that says office furniture. I'm going to put that off over here. So here's our office furniture. There's my T account. You've got your debit credit. And we're paying cash. So we're going to reduce cash by $17,000. That's a credit. So credit cash. And then we're going to increase an asset, which is your furniture, for $17,000. You're going to debit that for 17. So again, notice every time we do these, your debits equal your credits. Number 3 says you bought a fax machine for $1,050. Payment is due in 30 days, meaning you haven't paid cash yet. Fax machine would be office equipment, or just they're going to use office equipment. So I'm going to write office equipment right over here. All right, we've got our debit and our credit. And so it's $1,050. So we're going to increase our equipment $1,050 because that's an asset. And then on this one, I'm going to write accounts payable down here. We're going to have a liability because we haven't paid it yet. So accounts payable, here's our debit and our credit. That's going to be credited for $1,050. So notice debit equipment, which is an asset, increase your liability, credit accounts payable for $1,050. Number 4 says purchased a used car for $17,000 in cash. A used car. If I go up here, if I look at what account would I want to use on this one wouldn't be office furniture, office equipment. Looks like we're going to be using automobile. So I'm going to write out auto. We've got our debit credit. We bought this for $17,000. We're going to increase the auto for $17,000. And in this case, we're also going to be paying, it says we paid it in cash, so we're going to reduce cash for another $17,000. That's going to be a credit. So notice again, debits equal the credits. That's number 4. Number 5, Williams invested, notice another investment, an additional $11,000 cash in the business. That's going to be $11,000 debit. And you're also going to increase your capital by another $11,000. So that's going to get the credit. All right, that would be number 5. Number 6, bought a new computer for $4,000. Payments due in 60 days. So buying a new computer, that's going to fall under this office equipment category. That is for $4,000. So I'm going to debit that office equipment for $4,000. You haven't paid it yet. That's a liability. You're increasing your liability. So you're going to credit your accounts payable for $4,000. That's number 6. Number 7 says you paid $1,050 to settle the amount owed for the fax machine. You paid it, so that's going to be a credit to cash. $1,050, you're paying your bills, and you're going to debit accounts payable because you're reducing your accounts payable, so you debit that for $1,050. That's number 7. And then finally, number 8 says Williams withdrew $5,000 in cash for personal expenses. You're taking money out of the business, so you're going to credit cash for $5,000. And then the account we're going to use for this one is going to be called drawing. Anytime you see anything withdrawn for personal expense, for personal reasons, you're always going to use the drawing. So that's going to be a debit to that of $5,000, and again, you'd credit your cash for $5,000. So that's basically, I'm taking it more than what this problem actually is having you do it, because it just says use plus and minus signs to show increases and decreases. Guys, just remember, if it's a cash, the plus is the debit side, the minus is the credit side. If it's accounts payable, minus is on the debit side, plus is on the credit side. Capital, same thing. Minus, that's plus. For office furniture, again, plus minus. Office equipment, it's plus minus. Auto is plus minus. And drawing is plus minus. Just to kind of go back and you can review some of the rules of debits and credits.